Hello traders, Matt Chapman here, the creator of the trademark Trap Traders concepts. Welcome to today's Trap Traders Trade of the Day analysis. Today's date is Wednesday the 13th of December 2017, and we're sort of getting to that stage now where there's not that many trading days left in the run up to Christmas. People go on holiday. I personally don't really like trading much beyond sort of this week max. The thing is, if you're in trades, trying to go for 100 odd pips and things like that, or more, you might not make those types of gains during these periods. So you either have to make the decision to sit on your hands and assess your own performance and take that time to study and work hard. But obviously, maybe taking trades is not the smartest thing to do. Much beyond today, we do have the Fed later, and again, be a little bit careful of that, because if volumes have dried up a little bit, then you could see some type of wacky moves with a thin market. So just be aware of that. And as I said, don't think of it as a negative thing. If you're not taking trades between now and the new year, I often sort of pack in pretty shortly. This will be the last. This will be my last week, spend that, as I say, spend that time to really look deep at your own performances. Get your sleeves rolled up and really take a good look at how you've done, what you did badly, where you need improvement. Focus on those weaknesses and try and adjust and quantitatively have a look at your performance and on a trade by trade basis, and see where you need that work, and then spend that time to do that work. Same applies really when you've got downtime in between trades. That's precisely what you should be doing. You should be spending that time, rather than sitting around just scouring for trades, and if there isn't any, and sat watching YouTube or whatever. Don't do that unless it's a trading video that's improving your ultimately your performance. Because ultimately, guys, that's where you need to get to with your trading. The thing is with trading is there's so many different levels. People are at so many different places. It's very easy for people to just ignore this part of trading and just focus purely on results and strategy, when really what you should be doing is focusing massively on your own performance and the areas where you need work. And where these areas are. Whether or not you're patient. Whether or not you're too emotional. Whether or not you do certain things that are detrimental to your trading. And it's those things that you need to start adjusting and improving upon. So take it step by step, but really just look at every time you take a trade and boil everything down from your entries. Boil everything down to, are you being patient? Have a look and see what your psychology is like. Are you impulsive? Being impulsive is very common, and it's certainly very common in the financial markets, because the fear, the greed element that is prevalent, it can make somebody who maybe perhaps isn't impulsive in the normal day-to-day life, it can make them impulsive. So, for instance, take tonight as an example, the Fed, the fast-moving markets. Those types of markets are the types of markets that will drag someone off their process. So you might go into the Fed announcement as a certain type of trader, right? You've got a certain setup that you focus on, but the news event, the excitement of it, the hoopla surrounding it, right? The fast-paced, quick promise of money can drag you off your process and make you just be impulsive and coming off the sidelines, and then you take a trade, you didn't get a great fill, you're over leveraged at this point, you don't want to take the loss, and this can lead to all kinds of trading dreads, obviously. And the worst being, you just end up in a situation where you've averaged in a few times and now you're in big trouble. So is that something you need help with? What about the psychology when you first take a trade? What about during the trade? What about when you're closing in on your profit target? What about adverse price action? What about news events that are coming and you're in a trade? How do you deal with those? You want to basically plan for every type of scenario and think about like how you respond to those situations currently, and do you need work in that area, and then just focus on that one thing. So for instance, let's say that you get emotional near when price is nearing your stop loss. Well, you know, the only way to get around that is to be aware of that, and then the next time that you are aware that that's occurring, you then have to obviously change the narrative and talk to yourself to make that adjustment. Right, you want to use that brain power to make that adjustment, and the more you make it, the more that you don't care about that scenario, to the point where, you know, you'll still feel it, and that's a good thing, because, you know, if you start feeling negative as price comes towards your stop, it's a prompt. It's your own brain telling you, hang on a minute, you know, you're still very much involved. You don't like this situation. It's making you feel uncomfortable. These are prompts. You're prompting yourself to actually then have the conversation, change the narrative with yourself, and just say, you know what, it's a singular trade. It's one trade out of 100, 150 trades that I need to take to understand whether or not I'm going to be profitable or not over the long term. Who cares? Did I execute well? Have I taken a great trade? And if the answer to those questions are yes, then taking that loss is just a normal and necessary part of trading. That's a good thing. And I know a lot of people don't think of it in those terms, and that's what I'm saying about, you know, everybody is at so drastically different levels, but you've got to understand that if you're struggling, if you're not where you need to be, you've got to recognize that losing is a good thing. Right? Losing a trade is a good thing, providing that you execute on your process to the highest standards that you can. That's the key. And if you do have a trade that ultimately ends in a non-profit scenario or a loss, don't feel negative about it. Don't even call it a loss. I've talked about this obviously a few times now, but you know, it's a non-profitable trade, but you executed on your process to the highest of the standards that you are capable of, and then you move on to the next independent event. You're gonna have to recognize that on a trade-by-trade basis, the easiest way to realize that to allow you to get to that point is to realize that on a trade-by-trade basis, it's utterly random. Nobody in the world knows whether or not they're going to take a trade and it's going to make them money. It's an impossibility to know. So it starts with recognizing that's the reality of it, and when you recognize that, it kind of frees you up. It kind of abdicates you from the responsibility of taking the loss. It's like, no, you know, you can start to rationalize it and not be so affected by it, and then you've got to keep working on that, and you've got to recognize that profitable patterns emerge as you go forward. You've got to take more trades to get to the expected value of your edge, right? So your edge is your setup. You take your setup, but even if you take your setup and your edge was present, it doesn't mean you're going to be profitable. It just means that you executed correctly on your edge. Then you've got to allow the numbers to distribute over time, right? The law of large numbers. You've got to take 100, 150 trades to even realize whether you're anywhere near profitable. And again, when you recognize that you need to be looking at your trades in bigger batches, it then helps again to abdicate you further from the responsibility of the outcome of that singular event. It's just it's almost ridiculous that anybody gets emotional, right? I hope that makes sense. It's kind of crazy that people get emotional about it, but that's because, you know, people that have that wrong relationship with the outcome and with trading in general, and not realizing the game that they're in and how they're actually supposed to play it. You've just got to keep moving forward. Imagine this is a setup, and then the outcome is the outcome, and you move on to that next statistically independent event, and then you've got another setup. Your edge presents again, and again you just move forward, and you keep moving forward, and you keep moving forward, and that's what trading is about. And each one of these events is random. Right, you've got to recognize that, right? Again, how can you get bent out of shape if the outcome is truly random? You can't, right? And once you rationalize that in your own mind, you can then start working on and focusing where the important work should be done. And the important work is the process of your edge. the execution of your process and keep moving forward and keep executing to the highest standards. And you know, win, lose or draw, whether you make money or you don't, it's not about the financial gain or the financial loss. What it's about is, did you execute on your process, or did you make silly mistakes and just start coming outside of that process? Now that's where everybody falls short. That's where people have all the problems. Your job, the day job of the trader, is to manage risk. You're a risk manager. You're essentially facilitating probability. You're facilitating the coin toss, right? You flip that coin out of your pocket. It's absolutely possible that you could have 10 heads in a row. And okay, it's not exactly scientific because you're doing it, you know, sat at your desk, and you might flip the coin with different forces. There's atmospheric changes and things like that. But imagine it was like a scientific environment, that a coin was being flipped at a consistent force, and you know, the atmosphere was the same, and all of those things, everything being equal, it was a proper scientific test. You could still have 10 heads in a row. But hang on a minute, how is that possible? You know, 50-50, how isn't it 5 heads, 5 tails? Well, it's because that's not how probability distributes over the short term. To get to the expected value, you've got to keep moving forward. But you're not going to keep moving forward if you make a mess of your execution of the process. And that's why people get into trouble. And from there, they don't move forward because, you know, they blow their account. These future trades, they're never going to be involved in them because they're too busy holding on to massive losses in this trade here. Now, why did they do that? Well, they did it through lack of education, lack of understanding. That desire to be right or wrong, that desire to you must make money every day. It's just not how trading is. Professional trading is about moving forward and executing on your process every single time you basically come to take a trade. And you measure yourself not by the positive or negative outcome in terms of financial gain or loss. Not that. That's not what you're measuring yourself against. What you're measuring yourself against is how well you performed relative to that process. That's the key. That's what ultimately is going to make you become a professional trader. The day job of the trader is to focus and execute, and then quantitatively measure yourself against that performance, not the outcome. Do you have an edge? Number one, obviously you've got to have that. The next thing is, did you execute to the highest standards? So you may take a trade and you may have done a really good entry, you've managed risk correctly, you've not over leveraged, right? You've used the correct position size, you've entered the trade, your psychology was decent, but then as the trade comes against you, you get stopped out, you didn't like it, you were upset, but you did hold to your stop loss. But what that is doing, when you quantitatively look at that, you can delve into that point there that needs adjustment. You need to work on being stopped out and being comfortable with it. And when you feel negative about it, that's your body prompting you, brain prompting you to actually make the adjustment. And the adjustment is simply, you know, putting yourself in that situation, putting yourself in that pressure, and then just giving yourself a new message that I just don't care. I've done great. I've done tremendously well. I've took a good trade. And I don't want you to be excited by that. You never want to be excited or down. You want to remain neutral. But you can be intellectually okay with the fact that you executed well. And as the price came against you, you just literally, you tell yourself, I don't care, I've took a good trade. This is what I'm supposed to do. And if I lose money here, this is absolutely okay. Because it's one trade in 100 or 150 that I have to take before I can ever possibly understand whether or not I'm going to be profitable or not. It's just like the coin toss, right? Those 10 coin flips, you could absolutely have 10 heads or 10 tails in a row, but when you go beyond 100 or 150 coin tosses, then guess what? The numbers start to come together, and it starts to head towards, or will get to, your expected value. In that case, 50-50, right? So whatever your trading strategy percentage win rate will be, it comes later. You can't look at it over 10 trades. You can't look at it over 20 trades. You've got to look at it over bigger sample sizes. And then again, that's what I'm saying a little bit earlier in terms of, you know, how ridiculous is it then that we focus so much on the outcome of a single trade, or somebody, you know, starts trading a strategy a month in, maybe even a week in, and they're giving up. I mean, it's absolute madness. But that's it's not your fault. It's not the fault of the trader. It's the fault of the industry, because the industry hasn't been honest with people. And if they had, a lot more people would have stuck with strategies they've already given it a whirl with, but they didn't do it consistently enough for long enough, and they had perhaps a really bad relationship with, you know, the execution of the trade, the psychology of the trade, with losing money, all of these things. But for me, the psychology improves for the trader once you recognize that the single outcome's random, and that you need to be taking 100, 150 trades before you know whether or not you're profitable. That you've got to allow the law of large numbers to work for you instead of always against you, because over short sample sizes the numbers are lumpy and erratic, so that's why you can get 10 heads or tails in a row, right? Because over the short term you get lumpy, erratic numbers. It's not 50-50. So that's where people tend to get stuck. They take those few trades, you know, and this is presupposing people even go beyond that one single trade without making a complete mess of it, right? We've all done it, so I'm not standing here preaching, you know, pretending to be higher than thou. We've all gone through this, but I've gone through it, and I'm trying to help you not go through it. But even if you were to be able to get past that, you know, that first trade, 2, 3, 4, 5, 6 trades in a row that don't make you money, I can bet there's not many of you who have kept going beyond that point if you've experienced that. And just remember that coin toss example, and remember that in order for a trading strategy to have a full test, you need 100 to 150 singular events, right, statistically independent trades to occur before you're going to know. And have you hand on heart executed to the best of your ability? This is the question you've got to ask yourself, that many times with one strategy. And if you haven't, well, you've got your work cut out for you. You've got some work to do. And this is why I'm saying this period during Christmas is a great moment to realize the reality of this business, and realize your weaknesses, and realize where you need that work done. And the beauty of it is, though, that if you document it and if you quantitatively look at it, you'll realize, be aware in the trade where you're not strong. Be humble. Don't be a jackass. Do you know what I mean? Don't be arrogant. Humble is the answer in trading. You know, back in the day where you used to see people in the pits screaming and punching and spitting at each other, and, you know, people were really arrogant and boisterous. Those guys are dead. They're dodos. The way you make money with electronic screens is be humble and recognize where you're weak, and then work specifically in those areas. Just hold your hand up. You know, it's not a weakness to focus on your weaknesses. It's a huge strength. So yeah, I hope that makes some sense and gives you some focus, you know, between now and the new year, so you can come back in the new year and really, you know, hit the ground running. But as I said, I can't emphasize this enough. Just focus on that trade, that one good trade, right? And just focus on doing everything you can, doing everything right, and keep moving to that next statistically independent event. Just keep moving forward. And unless you can string together 100, 150 of these events and execute to the closest, as close as you can to perfect process, for wherever you are in your development, then you're not even trading. And anybody else, you know, and if you have a problem with that, if you're frustrated at somebody, if you're mad at an educator, don't be, because, you know, we've got to take a bit of responsibility here. If you can't do that, then the responsibility lies with you, in your hands. But it's not your fault. As I said, It's because you just haven't been told and explained the reality of the game. Because if you had, you'd keep moving forward, right? You'd buy that strategy and you'd keep moving forward until you'd given it a hell of a go. And you don't, and someone might say, well, you know, I'll lose a load of money between now and then. No, not at all. You know, you can simulate the trade this way. And then you can start to trade with a small live account, or you do it with a small live account. There's micro accounts and things like that nowadays. If you want to have a little bit of skin in the game, but unless you string together 100 or 150 trades, executing as close to your process as you can, then you know you're not really. You should never really be downhearted or disappointed or angry or frustrated as somebody else. Because the reality is, you probably haven't done that, and that's something that you must do. And when you start next year, you're trading, you know, have that fresh insight, that fresh vision about what you're supposed to do going forward. And that's that process. That's the thing is, the process is your process is going to be different to mine, right? And different to the next person. I've been doing this a hell of a long time, and there'll be people who've done trading a hell of a long time beyond me, who their processes might be, you know, a little bit better than mine. It's wherever we are in our development, we're always building on our experience. That's you know, a real key thing to understand. But wherever you are, wherever you find yourself, you've got to execute to the best of your ability. That's the most you can expect someone to do. And as you go through this process, you're going to improve. It's natural. The problem is when you're hemorrhaging outside of these processes, it's a lot more difficult to improve, because you just think, you know, the strategy isn't working, the educator's an arsehole, you know, whatever it might be. But you're not really looking at where the problem lies. The problem lies inside you, right? It's within you, and that but also where all those issues lie are where all the answers are. And if you switch on that awareness a switch, if you like, in your mind, then it allows you to go, do you know something? Mark's right. It doesn't matter about the outcome of the single trading event. That matters not. What matters is, how did I perform? This is my strategy. This is my risk profile. This is my, you know, my profit targets, my stops. Or, you know, even think outside of your process. Think about things like my process is also encapsulates things like, what if my broker goes down and I'm in a trade? What if I lose power? You know, think about all of these things as process as well. You know, did you journal? Did you make notes about your trade? Is there any areas that you didn't do so well that you could improve on? This is where your focus needs to be, guys. And if you can do that and realize that every statistically independent event bears no relevance to the previous trade and bears absolutely no relevance to what's coming in the future, right? And that you need to take 100 or 150 trades, got to string a good set, a good batch sample size together before you can ever expect to understand whether or not you're profitable or not. Just releases the shackles of being stressed about the outcome of the single trade, and it allows you to do what you're supposed to do, and that is focus on the process. So I hope you found that helpful, and I was just going to give you another little tip while I'm on. So this is kind of interesting, because there's obviously the debate that rages on about volume, and is there any use for it in currencies, because there's no centralized exchange. Sometimes people just dismiss it out of hand because of this, and it's wrong to do that, because let me just give you a reason why. From broker to broker, the numbers are different, right? One broker might have 100,000 customers, one broker might have 10,000 customers, right? So while the amount of volume traded will be different, what won't be different across the board is human psychology. So the measurement result will be different, but it will still show you an increase in volume, but the measurements will be different from broker to broker. But broadly, everyone's behaving the same, right? People are trading across the board, and there's that group herd mentality. So that's why volume can be actually insightful. And I just want to show you an idea in terms of entry. Look at these candles here. So you'll notice that the candles are showing some buying, right? They're not able to close anywhere near the lows. Now interestingly, if you take a look at the volume nodes, you'll notice that the volume is increasing as this is happening. So as volume is increasing, these candles can't close near their lows. What's that telling you? Well, it's telling you there's a potential turn coming. And if you look at the next node, which is negative, it's followed up by, on the chart, with an engulfing candle. Right? It was able to engulf all of those previous candles, and there's weakness in those prior candles on higher volume. It managed to do it on low volume. So what it's showing you is that behind the scenes there was buying volume going on. And yes, you can see that just with the candle, but you get an additional depth of analysis and understanding by realizing that, oh right, not only, yeah, there was some buying here, but what's important about that was on high volume. It didn't necessarily have to be on high volume, and that turn candle, that engulfing candle, occurred on low volume by comparison. So you know, the inference is that there's been buying. You should potentially take an entry. So I hope that helps, and if you'd like to come and join me in my inner circle, click on the link below. And if not, have a lovely day, and I hope that gives you some things to think about for your own trading during the Christmas period, and to help you hit the ground running in the new year. Take care.